Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help POA students like you ace their exams. Today, our practice question is from 2020 Paper 2 Past Exam. In this question, you are required to prepare the income statement and the balance sheet, which is now known as the Statement of Financial Performance and the Statement of Financial Position. Our main focus for today's lesson is to prepare the income statement and understand all the workings that are involved. So I need you to focus and follow through for an excellent understanding because our goal from this lesson today is to make sure you're able to score full 10 out of 10 in the main exam at the end of the year. With that being said, let's begin. The following balances were extracted from the books of Make It Limited on 31st of August 2020. So here you can see we are given a list of balances and some additional information, and our requirement is to prepare the income statement, which is now known as the Statement of Financial Performance for the year ended 31st of August 2020. So the question clearly says all these balances are for the year ended 31st of August 2020, which means on that basis, we understand that our financial year starts on the 1st of September 2019 and ends on the 31st of August 2020. All right. So these are the 12 months for which our income and expenses are to be considered when we prepare the income statement. So let's look into the first additional information which we have got. So the first additional information states at 31st of August 2020, general expenses $570 were accrued. So what do we understand by accrued general expenses of $570? Accrued general expenses refer to general expenses which we have incurred, but we still have not paid using cash, which means at the end of 31st of August 2020, this is a current liability for our business. Where do we record our current liabilities? We record our current liabilities in the balance sheet. So this accrued general expenses of $570 is to be shown under the current liabilities section when you prepare the balance sheet or the statement of financial position. Now, this $570 of cost or expenses which we have incurred belongs to the current financial year ending 31st of August 2020. If you look into the list of balances which we are provided originally, you will see general expenses is given at $20,300. But this balance does not include the accrued general expenses of $570 that we have incurred at the end of the financial year. Therefore, the total general expenses which we will report in our income statement is going to be $20,300, the amount which we have picked from the list that we were given, plus an additional $570, which is the accrued general expenses. Altogether, the amount is $20,870, and this is the amount for total general expenses which you will report in the income statement or the statement of financial performance. Okay. Now, let's move to the second additional information which we have got. The rent expense covers the period 1 September 2019 to 30 November 2020. We have already established that the business we are working with has a most recent financial year which ended on 31st of August 2020. This means the financial year would have started on 1 September 2019, and from 1 September 2019 until the end of 31st of August 2020, these 12 months are to be considered for revenues, income, and expenses when we prepare the income statement. Now, based on what the information says, we understand that rent has been paid from the 1st of September 2019 until the end of November 2020, which the question explicitly and clearly mentions. This clearly indicates that the rent has been paid in advance, all right? And the rent has been paid for 15 months in total initially, which covers the months of 1 September 2019 all the way until 30 November 2020. Now let's look into the balance for rent, which we are given in the list. So in the list, you can see that the rent is given at $48,000. So this means the monthly rent can be calculated now by simply dividing $48,000 with 15, because we understand that $48,000 was paid on the 1st of September 2019, and it is supposed to cover 15 months up to 30 November 2020. So the monthly rent after we divide $48,000 with 15 is $3,200. Now we understand we are working with a business where the financial year starts on the 1st of September 2019 and ends on 31st of August 2020. So what's the amount of rent expense for this 12 months? So in this 12 months, the total amount for rent expense is simply $3,200, which is the monthly rent that we have got, multiplied by 12, which are the 12 months we are talking about. And altogether, the rent expense for the 12 months are $38,400. And this is the amount for rent expense, which you will report in the income statement. Okay? All right, so we understand we had $48,000 originally, which we picked from the list of balances we were given. But based on our calculations, we understand that $38,400 is the actual rent expense that we have consumed or incurred for the financial year ending 31st of August 2020. So what happens to the remaining missing amount? First of all, the remaining missing amount refers to payment which we have already made in advance, and that is what we classify as a current asset, and we call it a prepaid rent. The prepaid rent are for the 3 months of September 2020, October 2020, and November 2020. We know the rent on a monthly basis is $3,200, so the rent for this 3 months altogether would be $3,000 multiplied by 3, which is $9,600, right? Or you can also find it as the difference between the list balance that we were given of $48,000 and $30,400, which is the expense we have calculated for 12 months, and that will still give you $9,600, which covers the 3 months in the next financial year starting 1 September 2020. Now, this prepaid rent is the rent payment in advance, and this is for the next financial year, which are the months of September 2020, October 2020, and November 2020. So at 31st of August 2020, when you are to prepare the balance sheet, you are to report this $9,600 within the current assets section, because this is referring to rent payment in advance for the next financial year, and we still have not used the economic benefits that comes with this prepayment. Okay, so make sure to report this amount as a current asset in the balance sheet. All right, now let's look into the third additional information which we have got. So the third additional information states, new equipment costing $4,000 had been posted in error to selling expenses. All right. If you have watched our previous videos on correction of errors, what type of error is this? If you have clearly guessed that correctly, it's error of principle. The reason we call this an error of principle is because we ended up recording the transaction in the wrong category. What do we understand by the wrong category involved? We ended up recording the purchase price of an asset, which is the equipment that we have bought, as an expense, which is a selling expense. So assets have been wrongly recorded as an expense. And as you understand, assets or expenses are different categories to each other. Therefore, the error is clearly within the fundamentals, and this is why we call this an error of principle. Now, the total equipment at cost that we are given in the list of balances is $341,000. Now, this amount needs to be added with $4,000 so that we can get the new amount for the total equipment at cost. So the total equipment at cost will actually be now $341,000 plus $4,000, because we are fixing the mistake we originally made, and that should give us a total value of equipment at cost of $345,000, and this is the amount which we will report in the non-current assets section in the balance sheet or the statement of financial position. Okay? Now, what happens to the selling expenses, which we recorded $4,000 extra? Now, the selling expenses from the list of balances that were given to us is $12,225. Now, when we are correcting this amount now needs to be reduced by $4,000, which originally belongs to the equipment, right? So 12,225 minus 4,000 will give us $8,225 as the amount for selling expenses, which is the correct amount that we report in the income statement or the statement of financial performance. Okay? All right. Now let's move to transaction number 4, or additional information number 4. Equipment is to be depreciated at 10% per annum using the straight line method. Now, the straight line method is pretty straightforward, where you calculate the depreciation by simply multiplying the given percentage with the original cost. but you have to be careful because we have made some adjustments for equipment, right? We knew that equipment, as per the balance given in the list, is 341,000, but based on the preceding transaction which we have fixed, we understand that this balance had to be increased by 4,000, and the total equipment at cost is in fact $345,000. Okay, so now that you want to find the depreciation of equipment, you just simply multiply the given percentage of 10 with the revised total cost of $345,000, and that gives us a depreciation of equipment using the straight line method of $34,500, which is clearly an expense, and all expenses are to be reported in the statement of financial performance or the income statement. Okay. Now, when you prepare the balance sheet, the accumulated depreciation of equipment, which you will be preparing as part of the non-current assets net book value calculation, you have to show the total depreciation. Accumulated depreciation simply stands for the total depreciation we have got so far for this specific asset. Based on the balance that we were given in the list, you can see accumulated depreciation of equipment is $170,500. Now we have to add an additional $34,500, which is a depreciation expense which we have incurred for the financial year ending 31st of August 2020. So the accumulated depreciation of equipment is $34,500 plus $170,500, which gives us $205,000, the amount that we will report in the balance sheet or the statement of financial position. Okay? All right. Now let's move to additional information number 5. Motor vehicles are to be depreciated at 20% per annum using the reducing balance method. All right. First of all, we are confident that we do not have to make any adjustments to the motor vehicle at cost amount because we do not have any adjustments. Now, how do we find the net book value? Every time you calculate depreciation using the reducing balance method, you always need to know the net book value. The net book value at any given point in time is simply calculated as the difference between the cost and the accumulated depreciation. The accumulated depreciation stands for the total depreciation expense we have incurred for the specific asset, which in this case is motor vehicles, since the day of purchase. All right. Now, the cost, as you can see from the list of balances we were given for motor vehicles, is $57,500. And then the accumulated depreciation from motor vehicles is $20,700. So we are subtracting $20,700 from $57,500, which gives us the net book value of $36,800. Okay? Now that we have the net book value, we can simply find the depreciation using the reducing balance method by multiplying the given percentage with the net book value. The question clearly states the given percentage is 20, and the net book value based on our calculations is $36,800, which gives us a depreciation of $7,360 for motor vehicles. And obviously, this is an expense which we will report in the income statement. Okay? Now, the accumulated depreciation total will be the same as what we did for equipment, and that is $20,700, which is the amount that we originally had for accumulated depreciation of motor vehicles, plus an additional $7,360, which is the amount we have calculated for the current financial year ending 31st of August 2020. So accumulated depreciation, therefore, is $28,060, and this is the amount which we will report as part of our non-current asset calculations in the balance sheet. Okay? All right. Now, before we move to step number 6, or additional information number 6, what do we understand by net book value? The net book value we know we can calculate as the difference between the cost and accumulated depreciation. But what does it really mean? The net book value stands for the economic benefits that are still available for consumption within this non-current asset, because we mainly purchase non-current assets for our business to help us generate more revenue. So if there are some net book value remaining, that is an indication of the economic benefits which are available within the asset that we can still utilize within our business to help us generate more revenue. Okay? All right. Now let's move to transaction number 6, or additional information number 6. The allowance for impairment of trade receivables on 31st of August 2020 is to be $9.85. Now, if you check the allowance for impairment of trade receivables, which we are given in the list, it's 1,220. And based on additional information number 6, we understand that at 31st of August 2020, this amount is now to be revised down to 985. So we can clearly see that there is a reduction or a decrease in allowance of impairment of trade receivables from 1,220 to 985, and the decrease in allowance is $235. Now, what do we understand by the reduction in allowance for impairment of trade receivables? Is it a good thing or a bad thing? Now, when there is a reduction in allowance for impairment of trade receivables, it indicates that there is now a good possibility for you to recover most of the credit sales that you have made to your credit customers in the past. If your allowance for impairment of trade receivables increases, that is like an indication that you may not be able to recover all the money. But when it decreases, it's like a positive indication that you now can hope to recover most of the money for credit sales which you have made in the past. So whenever there is a decrease in allowance for trade receivables, which in this case is $235, it is actually a good thing for the business. Generally, we report this amount within the expense section. Whenever there is an increase, we obviously add it to the total expenses. But now that it has reduced, when you prepare the total expenses section in the income statement, you need to show this number as if it has gone down. So you will show this number in brackets, which indicates that you are subtracting it from the total expenses. Okay. We will come back to that eventually, but just so you know the logic behind whatever we are doing. Okay. All right. So let's look into additional information number 7. A batch of inventory originally costing $9,270 was included in the inventory account. This could now only be sold for $7,280. All right. So we understand that inventory, which was worth $9,270, is now worth $7,280. Okay. So when we have to make adjustments for inventory, we must make sure that inventory is always valued at the lower of cost or net realizable value. The net realizable value is ultimately the selling price that you are able to sell your inventory for. Now, we know that we have to reduce the value of our inventory from 9,270 to 7,280. And this could be due to cases such as wear and tear and obsolescence, but you want to make sure that you get rid of this batch of inventory sooner so that you do not incur significant losses. You will take some loss, but not so significant. Now, in this case, because we have to reduce the amount from 9,270 to 7,280, we are incurring some losses, which is what we refer to as impairment losses. All right. So what's the amount for that loss? The amount for the loss is the difference between 9,270 and 7,280, which is $1,990. And this impairment loss is obviously an expense. In fact, any losses you incur in your business is to be treated as an expense, okay? And all expenses are to be reported in the statement of financial performance or the income statement. Next, the amount of inventory needs to be reduced by $1,990. Now, also remember that inventory is a current asset because we know we can sell this batch and convert it into cash pretty quickly, maybe in the next financial year. All right. Now, what's the amount for inventory given here? So inventory is given at 35,300, and we know this is a current asset. So the loss that we have incurred of $1,990 due to the impairment or the write-down which we have done, we need to reduce that 1,990 from the 35,300, which gives us $33,310. And this is the value of inventory, which we will report in our current assets section in the balance sheet. Okay. All right. Now, the last transaction, the bank loan was taken out on 31st of August 2020, which is basically on the last day of the financial year we're preparing everything for, and is repayable in full on 31st of August 2025. So this bank loan is repayable after 5 years, which is clearly an indication of this bank loan being a non-current liability, which means we do not have to worry about paying it this now, but we can pay this off fully after 5 years on 31st of August 2025. The last line says that no interest is payable in the year ended 31st of August 2020, which makes sense because you took the loan today. Why would you pay the interest for the entire year today? It doesn't make sense, right? So you'll have to wait for one entire year to pass, which is 31 August 2021, and then only you will be obligated to pay the interest expense that is due on the loan. But at the moment, the takeaway from point number 8 is that this is a non-current liability, and when you prepare the non-current liabilities section in the balance sheet or the statement of financial position, you are to report this bank loan amount of $30,000. Okay? All right. Okay, so that takes care of all the workings. Now we will look into the preparation of the income statement. All right, so I'll just change the format a bit so it's easier for you to see what's happening. So let me see what I can do with the template. One sec. All right, so it's going to be now sideways instead of us scrolling down. All right. Okay, so I'll just quickly go to point number 1 in terms of workings, and I've already prepared this income statement in advance. Now, during exam, you can include all the formalities that you will include in the beginning, such as make it PT Limited statement of financial performance for the year ended 31st of August 2020. You can mention all of those, but we are just directly jumping straight into this income statement. Now, this is the usual format of the income statement, which we're used to. So what we're going to do is make sure that we do not miss out any expenses, because we could have so many expenses, right? So we will do a thorough scan of all the expenses that we're given in the original list, and we will tick them off one by one. So that way we know that we have already taken care of this and included in our income statement, all right? Because our goal at the end of the day is to score full marks, obviously, right? So let's make sure that happens. Starting with the sales revenue. Now, let's check the sales revenue that we have got here. And as I've said, we are to put a red tick when we have used it. So we know the sales revenue is $425,275, and the sales returns need to be deducted from the sales returns, which is $18,050. Okay, so we have selected this too, which means this too needs to be included in the income statement. First of all, we have included the sales revenue of $425,275, and then we are deducting the sales returns of $18,015, which gives us the net sales revenue of $407,260. You can just do this in your calculator. All right. Next, after we've got the net sales revenue, we have to subtract the cost of goods sold, which is also the cost of sales. So subtract the cost of sales from the net sales revenue. The cost of sales is given to us as 226,930, and as you can see, we are ticking it off as we have used it in our income statement. Okay, so net sales revenue of 407,260 minus cost of sales of 226,930. When we subtract cost of sales from the net sales revenue, we get the gross profit, which is 180,330 in this case, which you can find out in your calculator. So you can see in this format, what we have done is all those numbers which we are subtracting are being represented in brackets just to highlight the fact that we are subtracting them. Okay. All right. Once you have got your gross profit, what's next? Now we have to list all the expenses that we've got. So we will list the total expenses one by one. And here, most students I've seen, they miss out on some expenses. So we will make sure we do not miss out on anything. Let's start with all the expenses we've got from the top of the list. Starting with the wages and salaries of 72,800. All right, so do we have wages and salaries of 72,800? Yes, we do. Okay, and then you can refer to rent here. So rent is actually not 48,000 because this $48,000 included additional rent payment for the next financial year. So based on our workings, which we have done for additional information number 2, the rent expense is actually $38,400, which is the rent expense for the months of 1 September 2019 until end of 31st of August 2020. So it's $38,400. So this is the amount you will see we have included here, rent expense of $38,400. All right. Okay. So we have already used rent. Next is general expenses. If you recall, based on the workings we have done for point number one, general expenses is to be increased by $570 due to the fact that we have some accrued general expenses, and which forms part of the total expenses incurred for the financial year ending 31st of August 2020. So general expenses is now $20,870 based on our workings for point number one. And this is the amount we want to show in the total expenses section, which we have actually done. All right. Okay. Next, we've got selling expenses. And if you recall, we deducted 4,000 from the balance of 12,225 because we wrongly recorded an extra 4,000 for the equipment. So this is to be 8,225 based on our workings, which you can see I'm circling on the right. So the selling expenses is $8,225. All right. Now let's look for any other expenses we may possibly have in the list. So equipment at cost is a non-current asset. Motor vehicles at cost is also a non-current asset. Accumulated depreciation amounts are basically contra asset amounts, which we will show in the statement of financial position. Trade receivables is a current asset. Trade payables is a current liability. None of these are relevant. Then we've got the allowance for impairment of trade receivables. We're not exactly using this amount, but we are to use the decrease in the allowance for impairment of trade receivables based on our workings, which we have done in point number 6. In point number 6, the decrease in allowance for trade receivables was 235, which is, as we have discussed, a good thing because now there is more possibility for us to recover the amount which we have sold on credit to our credit customers. And because this is a good thing, it is going to reduce our total expenses. We will report this amount in the expenses section, but we will show it as if it's a good thing. And how do we show that? We decrease this from the total expenses. So you will see in our list for total expenses, which you can see here, all right, at the end of included impairment loss in trade receivables in negative, just to reduce our total expenses. And this is in negative here because it's a good thing and it is reducing the total expenses for profit calculation. Okay. All right. Next, we have got what? We have got the cash at bank, which is a current asset. Not really a current asset in this case because we have a credit balance, which means it's an overdraft and it is to be reported as a current liability when you prepare your balance sheet. But in the case of preparing an income statement, this is not essential. Then we have got inventory. We know there is a current asset for inventory, and we also know based on our workings for point number 7 that we have an impairment loss, right? And the amount for impairment loss is $1,990, which is what we treat as an expense. So let's look into our income statement. And in the total expenses section, you can see that we have included impairment loss on inventory of $1,990. Okay. All right. Next, we check the list. We've got issued share capital, which is part of the equity, dividends, which is share of profits, retained earnings, which are basically reinvestment of profits. And then we've got a bank loan, which is a non-current liability, which we have clearly established based on the information given in point number 8, where we confidently understand that the bank loan is to be repaid 5 years from now, therefore fits the definition of a non-current liability. Okay. So the only things that we're now left out with is the depreciation calculations for point number 4 and point number 5. In point number 4, we found out the depreciation of equipment using the straight line method of $34,500. So you can see we have included that here. Depreciation of equipment, $34,500. I didn't write the full sentence. I just wrote DEPN of equipment short, but in exam, make sure to write the full thing, depreciation of equipment. Then we have got the depreciation of motor vehicles using the reducing balance method, which was $7,360. So you can see I've included depreciation of motor vehicles. Again, I've written in short, but make sure to write the full form in the exam, and that is $7,360. Okay. All right. So all the total expenses are taken care of. And if you add all these numbers here, right, and also deduct this at the end, which is the good thing that happened with trade receivables, you should get total expenses of $183,910. Okay. Excuse me. So maybe I'll just give you a few seconds to add those numbers in your calculator. All right. So these are all the numbers, and you get a total expense of 183,910. Now, our gross profit is 180,330 when our expenses are 183,910, which means our total expenses are more than our gross profit, which means we have made a loss. And the loss in this case is simply the difference between the gross profit and total expenses, which is $3,580. And I've kept this in brackets just to show that this is a loss. All right. You may not need to show it in brackets because you have already put a title loss, so which means that you've made a loss, so you do not really need to reflect that by including the brackets, but it doesn't really matter. Okay. All right. All right. So I believe that is a good lesson which should clear most of your confusion that you may have had before. And what I need you to do now is practice as many questions as possible. All right. And we have to make sure that we can get full 10 out of 10 in this question in the exam. All right. Because obviously that's what we are here for. You can check the link in the description beneath this video to book a free Zoom call with me and discuss your coaching requirements. You must bring your parents. We can help you prepare and get that result for your exam at the end of October. Also, if you want to see more videos on income statement and balance sheet, you can check this video that I'm linking on screen, and I'll see you in the next lesson.